Well, hi everyone. It's Russell Muldoon here from Enhanced Asset Management. Really hope this video finds you well today. Now, just with everything going on in terms of inflation, AI, and geopolitics, we just thought it'd be great to get this investment update from the investment team out, just in terms of what we're discussing at the moment, what we're seeing, how it's impacting markets, and how we're positioning. So we hope you find it informative. Now, first up, this is just a bit of a recap and a bit of an update on our latest quarterly from December, which I think came out late January. So we've updated the model at the moment to reflect the increase in bond yields on our valuation model to show the level of compression in implied multiples across share prices. So, unfortunately, in Australia, we have the highest inflation rate in the OECD. Arguably, it's due to government spending, and I think the RBA has articulated that pretty well, despite Jim Chalmers coming out and denying it's them, it's us. But no matter what it is, inflation's gone from 1.9 to 3.8%, doubling in a short period. It's obviously going higher with everything that's going on in the world at the moment. And based on that, bond yields have gone about 4.1% last year to about 5.1. Now, the bottom here shows a little table, and you can see the implied multiple goes from about 25 times a discount rate of 8% to a multiple of 20 times for a discount rate of 9%. So factoring in that 100 basis points of increase in bond yields because of inflation. So it's about a 20% contraction in share prices. So, that's a big driver of what we're seeing at the moment in terms of share prices. And I'll just go through a few examples with you here. Now, I just want to make note that these are very, very high quality companies that we've tracked for a long, long time. And all these share prices, I have to admit, I don't think I've seen anything outside of the GFC in terms of price contractions. So Pro Medicus, for example, down 64%, REA down 40.5%. I'll go through another 6 or 7 here, and you can see another technology company, T&E, car sales. You can see the price contractions on the right-hand side. A couple of financial companies here in GDG and Australian Ethical, a retailer, and also a consumer business, and then a healthcare company as well, just to show you how broad this contraction has been across share prices in the sectors that we cover. And then we have this little chart over here. So making up this underneath this little table is about 70 to 80 companies that we track. And you can see the average pullback from the highs over the last 6 months here, and the average about 32%. So a little model before, a simple valuation model before, showed a contraction about 20%. Share prices on average have fallen about 32%. So there's obviously a little bit more that's making up that correction. So, and we've got a fair idea of what that is. We'll get into that in a moment. I just wanted to detail that, since the GFC, Australian small caps have not traded this level of discount to large caps. Our market has barely fallen. If not, it's gone up a little bit while this is all happening underneath. Again, I haven't seen anything like this since the GFC. And it's not just our local bourse. So we've got a chart down here, which is the forward P of the tech sector in the US. And multiples have come down to a point where these are high growth businesses, but the forward multiples or valuation multiples are on par with consumer staples, which is a very low growth GDP type growth industry. So that's only happened 3 times in the last 7 years: COVID, Liberation Day, the bear market caused by the Russia-Ukraine invasion, and we're seeing it now. So eventually this is going to be a tremendous opportunity to lean into. But this is only one impact on our markets at the moment. There's another 2, which I'll talk to in detail in a moment. So the first of those is artificial intelligence. Now, I think this table shows it pretty well in terms of adoption over here on the left-hand side. All these little dots here represent about 3.2 million people per dot or per square, with the entire graph representing about, I think it's 2,500 dots, which is 8.1 billion people. Now, the grey area are those people that haven't even touched AI as yet. So you can see adoption is very, very early. The green is those who possibly use ChatGPT. What's the weather going to be in Adelaide? What's the cheapest route I can get to Sydney from Singapore? The very casual sort of users that are just using prompts to get answers rather than using Google, for example. Those who are actually paying to use AI and develop processes and efficiencies is very, very small in comparison. So only about 15 to 25 million of the 8.1 billion people in the world are paying to use these resources at the moment. And the red is those people who are, probably largely software companies, technology companies who are using it to legitimately build technology stacks on top of current software businesses. So you can see it's very, very early on. Now, up until February this year, AI has been touted as a huge benefit for businesses in that the efficiencies being able to gained would be massive. But all of a sudden, it's moved from a benefit to a huge threat. We've seen some people come out and actually, not have any technology experience before, and literally build software that mimics the looks and the feel of some of the largest companies out there. And this has caused a bit of panic within the investment industry, and we've seen software companies being sold heavily. Now, we've also seen that move into other areas like financial services, industrial companies. It's really starting to morph. The fear of AI adoption, the speed of its adoption, has created a very panicked sort of market, and it just feels to us a little bit early to understand the impacts that AI will have on businesses. But the market is definitely approaching it as a sell-first opportunity. So here is another interesting chart where we can see the theoretical potential of AI, and the red being what's actually occurring, what's actually being deployed. And it's about 5% of AI's potential at the moment is actually being used in the real world. So there's a lot of growth to come within AI being deployed within businesses. And again, like the impacts of these red areas going and yeah, driving all these efficiencies within management, legal industries, arts and media, office and admin. They're just unknown. But again, the market has certainly adopted a self-first narrative, and we estimate that's probably taken about 1 to 3 PE points off of a lot of the businesses, and particularly the small and mid-cap industries, which is about 5 to 10% on average. So if we combine the 5 to 10%, which is about 10% on average, with a 20% reduction in interest rates, we get to that 30% level, which is where, on average, share prices in our universe have fallen. And then, of course, layering on top of that, we've had energy prices rise as sharpest they have since 1978 on the latest conflict in Iran. Now, I don't want to be the bearer of bad news, but every time oil prices have sort of breached this $100 a barrel level outside of COVID, COVID, of course, because the governments flooded the markets with an insane amount of fiscal and monetary help. We've had recessions. So the GFC, we had a recession in the 90s, the recession we had to have. We've had the 1980-81 recession. So we're at that point now where oil prices are above $100 a barrel. So the pressure is on at the moment in that not only our economy, but all of Asia, all of Europe could fall into recession the longer that this conflict draws out. Now, US seems to have put themselves into a pretty good position. They're a net energy exporter, whereas most countries, like including Australia and Japan, for example, are huge net energy importers. So oil going up is a huge shock to our economies. Now, let me just make one thing very, very clear. Iran is a 20% exporter of oil to the world. It's very hard to replace that in short order. Very hard for other producing countries to pick up that slack in short order. It will take years if Iran comes off stream. Likewise, this conflict has been spreading. Gas fields in Qatar, which is 20% exporter of gas, and about 20% of that field is now impacted by explosions. So, look, potentially the world has never ever entered an energy shock like this. So I just want everyone to be prepared. If this war goes on longer and it deepens, the impacts are going to be quite severe. Now, that is, of course, to say, regional conflicts, global conflicts are always different in duration, in nature. The resources impacted, Russia, Ukraine, for example, both are huge, both soft commodity and energy commodity exporters. That's obviously been able to be rebalanced over time, but trying to rebalance 20% of oil and gas over time is going to be a significant challenge the longer that this conflict draws out. Now we're starting to see a bit of movement in bond markets, which predominantly means that when yields start to move sharply like this, the market's rapidly repricing the economic outlook. And you can see that on the right-hand side with yields both in Australia and the US climbing. So that we're starting to see a little bit of stress starting to appear in the market, which is, in our view, arguably why Trump came out this morning and said that they're negotiating with the Iranians for a bit of an off-ramp. Now, that may be to soothe markets, that maybe give them time to rearm. We don't know. What we do know is the off ramp is looking increasingly difficult as this war progresses. But typically, when markets start to break, Trump effectively is known to taco, so Trump always chickens out. We just think that that's getting logistically a little bit challenging the longer that this war goes on. Now, as I said, the recession is a possibility the longer the conflict draws out. Now, we've seen price corrections up until this point in share prices. What we could move into if we have a recession, is we move into the earnings correction phase, and that is economies contract, and therefore the businesses that underline those economies also contract. So when earnings contract, share prices are effectively a multiple, business valuations are effectively a multiple of earnings. So if you get with where you had the lower the contraction in share prices, if we get lower earnings, you obviously are multiplying a lower denominator. Multiplying a lower earnings figure by a lower price point, you get lower share prices again. So, and I love this chart over here. I continuously roll this out. Brown represents earnings over time for the S&P 500 since 2000, and blue represents the S&P index level over time. The correlation between share price and earnings is about 98%. So if we do enter a bit of a recessionary phase here, you can naturally expect 98% of the time it's going to lead to a lower index level because earnings have fallen. Now, Besant's been in the press on the weekend saying we're going to have 50 days of elevated prices for 50 years of no Iran nukes. So on that basis, we can probably imply we're about halfway through this conflict. I hope Trump is right. I hope they're negotiating. I hope there's an off-ramp soon, because as I said, the longer this goes on, the more serious the implications potentially for the global economy, because we have never ever seen a potential energy shock like this. It is a little bit scary. It's scary for everyone in terms of critical resources, getting your hands on petrol, the bowser, diesel, travel, jet fuel, fertilizer for farmers, costs just to get around. It's a hugely inflationary, demand destructive exercise if supply can't be fixed soon. Now, markets have obviously been a little bit sanguine to all this, with S&P only down a little bit. Even our own market hasn't even into a correction phase. So again, that probably plays to the narrative that the markets want to see Trump taco as soon as possible, and I really hope that happens. But because we can't really see that happening in short order, we have taken a deliberate and considered adjustment to every single one of the portfolios that we manage, and that is we've increased the defensive positioning. So you'll see the last couple of weeks we've increased cash levels across all portfolios within our allowable limits. Possibly can go a little bit further, but we're kind of at the max range of what we're allowed to do under our license. And that is a deliberate repositioning. If this gets worse and markets do go into recession, we can naturally expect earnings to fall and then markets to fall. But just to be, just to recognize what we've just experienced, and that's a rally that's been occurring for the last 3 years. We've experienced multiple years of double-digit returns. Portfolios have really benefited. So to take a bit of a defensive position now, we think is prudent. Um, and just to make note that we're all in this for a 10 to 15 year journey. We've had since we've been together, we've had COVID, we've had the Ukraine Russia war, and now we've got the. Well, that's all from us for this video. Again, we hope it finds you well, and just remember that although we have seemingly everything going against us for the moment in terms of inflation, artificial intelligence, and the current conflict in the Middle East, um, these are obviously headwinds as we've shared. But on the flip side, when inflation eases, when the current fear around AI eases, and the war eases in the Middle East, these all become natural tailwinds for the markets again. Markets go through cycles. They always have. They always will. We've seen many of these before. We're currently experiencing another one. It hasn't been a lot of fun, and like I said, it's probably the worst we've seen since the GFC from our perspective. But, things will always get better. They always do. The sun always rises the next day. So we are on the lookout for those trends developing. So we'll keep you updated. So thank you, and we hope you have a great day.